Hi, I'm John Prasinos, Editorial Director of Investing Daily, with a video presentation for Monday, April 24th. To view our full range of trading services and publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. You know, I've been in the publishing business for 40 years, and throughout those decades, I've heard the same old whining from the perpetual gloomsters. America is in decline. Our society is falling apart. We're no longer economically competitive. The US dollar will get dethroned. Our manufacturing base is hollowed out. During the 1980s, it was all the rage to argue that Japan would take over the world. Didn't happen. Now it's supposed to be the Chinese. I submit to you that the Chinese won't take over the world either. I turn your attention to super investor Warren Buffett. The Oracle of Omaha currently has a net worth of $113.5 billion. So he must know what he's talking about. And here's what Buffett once said: never bet against America. As we contend with the pandemic's aftermath, inflation, rising interest rates, geopolitical strife, and the Russia-Ukraine war, Warren Buffett's dictum is more apt than ever. Stay invested and position your portfolio for the new secular bull market that's sure to come. Our flagship publication, Personal Finance, recommends the following portfolio allocations under current conditions. Tweak these percentages according to stage of life and risk tolerance. Don't get too defensive by giving stocks short shrift. I favor U.S.-based large-cap stocks, especially in the technology sector, which was beaten down in 2022 and is now in the midst of a comeback. The prestigious Economist magazine recently published a report on America's economic performance over the past 3 decades. From my perspective, here are the salient findings. Today, America accounts for 58% of the G7's gross domestic product, compared with 40% in 1990. In 1990, U.S. GDP per capita was roughly equal to that of Europe and Japan. The U.S. is currently far ahead of both at about $80,000 compared to $39,000 for the European Union and $36,000 for Japan, approximate figures in U.S. dollars. In 1990, American income per person was 24% higher than the income per person in Western Europe. Today, it's about 30% higher. The U.S. accounts for 22% of the patents in force abroad compared to 19% in 2004. American labor productivity increased by 67% between 1990 and 2022 versus a 55% increase in Europe and 51% in Japan. Now, to be sure, China has racked up phenomenal growth over the past 3 decades to surpass Japan as the world's second largest economy. And as this chart shows, China is on track for stellar growth in 2023. But keep this in mind. In 1990, America's economy accounted for about 25% of global GDP, and in 2022, it still accounted for about 25%. Here's the best statistic from the list. In 1990, if you had invested $100 in the S&P 500, which after all is an index of American companies, you would have about $2,300 today. Okay, let's recap the past week in the markets with a look at the week ahead. First quarter corporate earnings results have been a disappointment so far. The largest U.S.-based banks started the Q1 season with a bang, but as other companies and sectors reported operating results, the bang has turned into a whimper. The latest economic reports have been a mixed bag as well. Business activity in the U.S. private sector expanded at a strengthening pace in April, with the S&P Global Composite Producer Manufacturers Index, PMI, rising to 53.5 from 52.3 in March. However, the Fed's Beige Book last week described job gains in early April as, quote, moderating somewhat. The report indicated that consumer spending, factory activity, and construction activity were either flat or down slightly this spring. These cross currents dragged down U.S. stocks, with the main indices finishing last week in negative territory. Take a look. The Dow Jones Industrial Average fell 0.2%, the S&P 500 fell 0.1%, and the tech-heavy NASDAQ fell 0.4%. The benchmark 10-year Treasury yield rose 0.1% to reach 3.57%. Crude oil prices fell 5.6%. The end of the Fed's rate tightening cycle is in sight. which means the cyclical peak in long-term yields was reached last year. It's telling that the tech sector has been outperforming lately, a sign that investors are looking ahead to the normalization of interest rates and faster economic growth. This week, earnings reports from big tech will occupy center stage, and the numbers are generally expected to be at least respectable. Now let's take a look at the week ahead. In addition to earnings results from the mega-cap tech companies, the following economic reports will garner Wall Street's attention. S&P Case-Shiller Home Price Index, new home sales, consumer confidence Tuesday, durable goods orders Wednesday, U.S. GDP initial jobless claims, pending home sales Thursday, personal income, personal spending, consumer sentiment, and the Personal Consumption Expenditures PCE Price Index Friday. The biggest report this week will be the PCE numbers. PCE, specifically the core measurement, is the Fed's favorite inflation gauge because it provides a more comprehensive picture of costs for consumers. The most recent inflation reports have pointed to cooling inflation. Friday's PCE reading is expected to show a continuation of deflationary trends. In the meantime, if you're hunting for high yields, but you also want to mitigate risk, consider my colleague Nathan Slaughter, Chief Investment Strategist of High Yield Investing. As a high-yield expert, Nathan has devised a simple strategy that could help you generate a steady stream of cash. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. If you have any questions or feedback, send me an email at mailbag@investingdaily.com. Well, that's it for now. Thanks so much for watching.